Sometimes those early, big, some might say crazy risks can pay off. Our next guest knows all about that. Mike Maples gave Evan Williams money for Odeo, which didn't take off, but his investment eventually did in a company you may have heard of called Twitter. Maples is managing partner in a $75 million micro VC fund called Floodgate. He's also invested in Chang, DIGG, and Gowalla, among others. Mike, great to have you here on Bloomberg West. So I want to hear a little bit more of this story. You basically had faith in Evan, and you would invest in anything that he did. And that's how important investing in the founder is to you.
Well, yes. I think to have a great company, you need two things. You need great founders and a great opportunity. And when we invested in Odeo, within 1 week, Apple decided to give podcasting away for free on iTunes. And so Evan struggled to find a real business for the next 6 to 9 months and eventually just came back and said, we don't have one. So he offered to give me 100% of my money back. And I thought that just such a unique gesture for an entrepreneur that I didn't care what his next thing was. And so he described Twitter to me at the time. I didn't fully understand it. It was either going to be called Twitter or Voicemail 2.0. He chose the right name, I think. Although at the time, Twitter didn't have any vowels. It was just TWTTR.
And people thought Twitter was crazy. I mean, it's evolved so rapidly from...
Right, yeah. So when we, even after investing in Twitter for the next couple, 3 years, I basically had to defend the investment from people who would say, why would you invest in a company with 140 characters or less and no roadmap and they can't keep the site working and, you know, what's that all about?
So Twitter has evolved from a social network to a news network to kind of a gauge of cultural sentiment. We're hearing reports that Jack Dorsey, another founder, is considering going back full-time as chief product officer. Does Twitter need Jack to get better?
Well, I probably shouldn't comment on that, let Twitter make that statement. But I think Jack is a supreme talent as an entrepreneur and as a product person. And so any influence that he can have on Twitter is obviously good for me as an investor. So anything he can do is great.
Mike, so basically you're saying you gave him the money to buy a vowel for Twitter? That's good stuff.
Well, I guess not exactly, but it's funny because there was something that Evan said to me at the time that I think was pretty profound. He said, you know, before Odeo, I had a company called Blogger, and we could get about 1 million people to write blogs. And so if I could allow people to write microblogs, maybe tens of millions of people would do that someday. And so I thought, well, if anybody can make that happen, these guys can. And so there was a little bit more than just, hey, let it ride on Evan. I think there was something profound behind the idea, even if it was controversial.
Talk to me about finding these entrepreneurs and how you get yourself next to those people that are going to come up with the next big thing.
Well, I'd say the number one thing we look for is authenticity. And so when we think of the term serial entrepreneur, it's not necessarily a positive. We like people who have an authentic passion for what they're doing. One company we're invested in, ModCloth, was started by a woman who's been thrifting for clothes since she was 13. WordNick was started by Erin McKeon, who is a lexicographer for the Oxford English Dictionary. DIGG was started by Kevin Rose, who'd been a media personality in the past. And so time and again, we found that the authentic entrepreneur with the authentic voice and the real passion creates the valuable companies, even if they're controversial at the time.
So talking about DIGG, Kevin Rose has left the company. There are reports he doesn't even use the service anymore. What went wrong, and can it come back?
Well, I think that when DIGG was really famous and everybody was in love with DIGG, it probably got too much credit, and I think the market's probably a little too negative on DIGG right now relative to its performance and what it's delivering. And so I actually think DIGG is on the right track. You know, their usage has gone up recently. They have a new CEO who's doing a good job. Most of the user reviews of it are actually quite positive. So I think that DIGG just needs to focus on their users one day at a time. And, you know, I don't feel too sorry for a site that has tens of millions of users. So I think that they've still got a shot.
I mean, what do founders worry about? I mean, do they worry about becoming the next DIGG or the next MySpace? Do they worry about becoming irrelevant?
Well, I think that founders have a wide variety of motivations, and it's incumbent on us as investors to try to find the people who are trying to build the really big company that's going to make a meaningful difference in the world. And so most of the great founders that we've seen are those who just want to make a fundamental impact and a difference. And usually the startup is their vehicle to do that in the world.
You're getting involved in these companies very early, and I wonder what you do to try to imagine a business plan that doesn't exist. How do you think of how your investment is going to turn into X number of dollars over X number of years? How do you pencil that out?
Right. Well, we either invest too early or way too early. And so we're investing in these companies that are incredibly risky and controversial, but also at very low valuations. And so we don't really have an investment thesis in the traditional sense. We look for a visionary entrepreneur chasing a huge opportunity. And then we ask, how does their authentic knowledge translate into a set of fundamental advantages? And if we can help that entrepreneur prove their idea for not much money, that's what we're really in it for. In companies like Twitter, there's no way to predict how big they'll be. But if we're right and the results are spectacular, we're going to come out okay because we're coming in at a low valuation.
All right, this is venture capitalist Mike Maples, one of the earliest investors in Twitter. Talking a little bit more about Twitter, you've got a company that their valuation has hit $7.7 billion. According to eMarketer, they brought in about $150 million in revenue last year. How is Twitter going to make money? And is this what keeps them up at night?
Well, when you look at the historical sweep of the tech industry, the truly exceptional great companies are valued in the tens of billions of dollars. And so I don't think that Twitter is necessarily being valued on today's revenues or even next year's, but really the chance that they could become a truly fundamental, important company in the software business or in the tech business at large. And I think that a lot of people can defend that they're a strategically relevant company. They're changing media, they're changing news, they're changing entertainment, and they've done it in less than 5 years. So I wouldn't bet against them yet.
So what is it that keeps them up at night? I mean, what is their worst fear? I mean, I know they're working very hard on evolving the product and trying to make money and monetize what they have.
Yeah, well, without speaking too much for them, I think that they're a very idealistic company. And so I think they're still very much in the phase of driving usage and engagement and just being the best service they can be. And I think that they understand that if they achieve that goal, that success will come their way. And they have plenty of time and plenty of money. And so they've been a very patient team. And so far that's served them well.
Mike, I know you're an animal lover. Let's talk about thunder lizards. What's a thunder lizard?
Well, yeah, so I got that metaphor from Godzilla. So Godzilla was hatched from radioactive atomic eggs and swam across the ocean and started to destroy cities. And I always thought that was a good metaphor for the disruptive startup. And so the atomic eggs are sort of a metaphor for the thunder lizard ambitions of a company. And then, Godzilla stomping around and smashing cars and trains and throwing things around and breathing fire on buildings is sort of a symbol of disruption and taking out the competitors and the incumbents in the market.
So those are the companies you're looking at? You're looking for the thunder lizards?
I am. I think that the tech business is a business of exceptionalism. And in any given year of the 10,000 companies that get funded by angels, about 15 of them are truly meaningful, and about less than 5 are truly dramatic breakout successes. And so our entire business is about finding those companies earlier than the next person can.
In talking about true thunder lizards.
Yes.
And the question of a bubble.
And Twitter's starting to show some thunder lizard,
Oh, you don't think Twitter's a thunder lizard already?
I think they might be. They're encroaching. Yeah.
Okay, so moving into this question of is there a tech bubble? You recently said round it off to the nearest yes. Yes. In a given year, there are maybe 10 or 15 companies that are truly valuable, and then everyone crowds around the soccer ball. Those companies end up having their valuations get away from them. So which companies' valuations are getting away from them?
Well, so first of all, I think that there are companies that are legitimately valuable. So I think that you can make an argument that companies like Twitter and Facebook and Groupon are legitimately valuable companies.
Valued at what they're valued at,
valued at what they're valued at. And the
Facebook
reason is that
$80+ billion.
Sure, but Google's worth, $150 billion. And so the companies, the Intels, the Googles, the Microsofts, the Ciscos, the true breakout winners with the long-term franchises are very valuable companies. The ones that I think are at risk are the ones that are the potential false breakouts, the ones that either haven't demonstrated that much in the market yet but have a lot of hype and a lot of attention, or those companies that are sort of knockoffs or Me Too's. I think those are at risk. And I try not to diss on any companies in particular.
Come on, what are the false breakouts?
I don't know if there's any false breakouts, but I think that there are companies being funded at very high prices that have not yet proven in the marketplace that they can be one of those franchise breakout companies.
That leads to this question of the secondary markets. Obviously, they're giving companies more liquidity, relieving the pressure to go public. But do you think they're dangerous?
Well, I have mixed feelings about that. And so on one hand, it's true. People are buying shares in these secondary markets with very little, if any, information about these companies. Less than on some of the rinky-dink off-market exchanges, even. And so that bothers me. Having said that, a lot of this, I think, is a symptom of Sarbanes-Oxley. And so the government tried to correct Enron with Sarbanes-Oxley, and I think it was bad legislation and had unintended consequences. And so I think it was the government's interventionist tendencies and poor legislation that caused much of this. And, essentially the marketplace is trying to fill the vacuum created by the government and its lack of leadership.
Oh, there's so many more things we could talk about, Mike, but we have to go. Great to have you here on Bloomberg West. Mike Maples of Floodgate.
Thanks for having me.